Investors are making chaotic trades. Hi, everyone, and welcome to Ainslie Insights, brought to you by Ainslie Bullion, Ainslie Crypto, and the Gold and Silver Standard as the Ainslie Group celebrates 50 years. Today, we welcome back Sam, who's been looking into some unusual trading activity by market participants that could be a sign of trouble on the horizon. How are you going today, Sam?
Very well, Chris. How are you?
I'm good. Now, it's been very interesting in the markets over the last few days. We've seen the S&P 500 breaking those record highs again. Very exciting if you look at it from one angle, but you raised some concerns in the article today. Should investors be worried about a downturn? It certainly seems like they're not.
Well, it might seem like people aren't worried about a downturn, but this style of trading that's been happening is actually quite reminiscent of a fear in the markets and a potential downturn. Because when people are worried, that's when they start trading more emotionally and they start rotating in and out of things quite aggressively. So what you can see is really large percentage changes happening based on earnings, which don't usually happen to this degree because certain companies are pretty much being dumped and certain companies are being picked up, and there's a lot of FOMO in the markets. So it's looks a little bit almost like a rally and other things like cryptos. You know, it's getting really volatile, and people are behaving emotionally.
See, that's really confusing to anyone looking at the chart, because if you're looking at the chart, you can't see it, right? Like all you can see, particularly the S&P I'm talking here, is a very somewhat smooth and up and to the right chart that just keeps progressing, seemingly marching on unfazed by anything. So where are you spotting these negative results when those indices keep rising?
Well, the negative results are coming in certain companies.
Right.
So if you look at an index, what it is, I mean, it's weighted to, have certain companies and avoiding other companies. So maybe an index isn't the best way to look at the markets. But just for example, if you look at FMC, they had a little bit of a miss, mostly due to weather. So nothing wrong with them specifically, but they dropped almost 12%. And that is a shocking drop for a company just based on, one little earnings miss. So the companies that aren't doing well, even just slightly, are getting the rug pulled out from under them. And then the companies that are doing well are getting these incredible boosts. We're talking about 10, 20, 30% upwards. And this sort of trading just doesn't look sustainable.
So that's really interesting, because does it mean, like, when I say we're not seeing it, we're not seeing it even in the volatility index or in those volatility measures.
No,
But
we're not.
I think what you might be describing there is that we've got effectively these big hits to the downside and big sort of boosts to the upside,
Yeah.
possibly canceling each other out when you
So
actually
the
look at it at an index level. Is that what's going on there?
Yeah, so the weighting is more towards the positive companies, and then people are piling all into those ones. So it's really rotation of capital into where people feel safe. People are all looking for a lifeboat. It's not really people are excited. They're euphoric. They think it's going to go up forever, in my opinion. In my opinion, it looks more like people scrambling for a lifeboat.
That's a
you wouldn't
that's
say you wouldn't say, oh, this boat over here is doing really well. It's more like, well, people are momentum trading. They're piling into the one that seems to be strong so that they don't fall down.
Yeah, right. And that's really interesting from this angle of sort of looking at but differently to how everyone else is looking at it. Because if you look at those volatility indexes, you would tend to think smooth sailing. And what you're saying there is that's absolutely not the case. So do you think then that we're really just seeing a lag in those volatility indexes? Do you think that volatility is going to come back into the market in a really measured way? Because as you're describing it, the volatility is really already there, just not necessarily on the surface. It's sort of hidden beneath the surface. Do you think we're
Well,
going to see
the
broader volatility come back?
what I mean was the emotional volatility is
Right.
there, but we haven't seen it in indices such as the VIX.
Yeah.
So that's been sitting well under its 20-year average. It's been very low. So the volatility is lower than it's been the last couple of decades, and things look really smooth, which which is a sign, if you're into, you know, technical analysis, that things could be swinging the other way. And it'll be interesting to see what people go to next. I mean, if we get something like a 10% downturn in an index, are people going to run to gold or silver? Are they going to, you know, run to Bitcoin, things like this, or is it going to be a variety? It'll also be interesting to see what happens with the so-called safe haven currencies, because US dollars kind of made its way into being a safe haven currency as of recent. But if things start crashing, that makes a rate cut more imminent as well, which could mean US dollar could get damaged as well. So this huge run up in the S&P and the other indices, I think it's more like an illusion that these tech companies have so much weight and they're propping everything up, and that everyone's running to the biggest percentage, to the, you know, number that's going up as fast as possible.
I'm really interested to see how this does unfold, because when you look back at some of those charts historically, it's what you said before, that, you know, when you're looking at it from a technical point of view, when you have that real compressed volatility, or really everything looks really smooth, and you can see under the surface that things are not as they seem, the reaction can be quite swift, and that has generally coincided with major market tops in the past. I don't know how to read it this time around, because I wonder whether the market is or is going to interpret it somewhat positively if we do actually see those indices come off a bit and start to fall, because any sort of momentum behind the Fed cutting, or all that sort of trade, at least initially, will probably be seen as quite positive. So it really is a confusing time to be looking at all this, isn't it?
Yes, and we did have, I guess you could call it a rumor started by Jerome Powell that they were going to cut sooner than expected. And all that looks like it did was it allowed the commercial real estate sector to be able to, you know, refinance or hold off a little bit longer, so they didn't, you know, have too much trouble paying the interest on their loans. And now we're back to, you know, a rate cut coming a lot later, so than expected right after that. So
Hmm.
um, they're playing a dangerous game with interest rates moving around the expectations. But what eventually hits is when people just can't pay their bills, when people are selling things off, when they don't have any disposable income, and then the part of the population that can't just go out and, you know, refinance and move money around or get a line of credit so easily, when they feel the pinch and a downturn comes, an announcement of cheaper interest rates coming on the way isn't going to really help them too much.
No. And when you say playing a dangerous game, I think I saw someone commenting wherever I was reading it that that window is really closing for this idea of a soft landing, because they keep playing this game. It really feels like we could be getting to the pointy end of that, where you do see a top, because obviously at some point a top is coming in those indices, and we really need to see how that unfolds, because there's two paths it can follow, and one of them is not very good. So it'd be interesting to see what happens.
Yeah, and as you've highlighted, the liquidity hasn't really done much of anything. If anything, it's been held up really strongly by the Fed in the background, you know, creating a bunch of emergency liquidity. But as we know, that has to keep multiplying by many magnitudes just to keep things where they are. So
Hmm.
any little pinch to that could really damage markets.
All right. Well, we'll keep paying attention as always. Thank you for your work on that today, Sam.
Thanks, Chris. Always good.
Thanks everyone for watching, and we'll chat again soon.